Welcome into another Tax Talker. Today we have a back to basics on tax planning. What is it? Is it just looking for loopholes? Is it just for the rich? No, not really. Tax planning is understanding how the system works. Sure, there's the sketchy people that really want to push the envelope on how that system works, but many taxpayers can benefit from knowing how the system works, how it affects them, what behaviors it rewards, and what ones it kind of punishes. About making smart decisions before December 31st, and certainly before you have to file your tax in the spring. Let's get into it. Tax law is not random, although it can feel like that at times. But no, it's social policy. Lawmakers use the tax code to encourage things that are broadly good for social cohesion or the economy, or just good behaviors in the macro sense, like homeownership or retirement savings or starting a business. And you multiply this over many different facets of life, and that's why the tax code is not simple. It's not just a flat tax on everybody at one rate. It's full of incentives, but then that creates the need to have exceptions and caveats so people don't take too much advantage of those incentives, because at the end of the day, tax code still has to raise revenue for the United States government. So this is the constant yin and yang of our tax code and the social policy underlying it. It's absolutely true that there are parts of the tax code that exist because of special interests and lobbying. The world's not perfect. But the fact is, most deductions and credits exist because they're quite popular. Families love the child tax credit and they want more dependent care credit. Homeowners want the mortgage interest deduction. Business owners always want more depreciation. Taxpayers were furious over the state and local tax, the SALT cap, and there was enormous political pressure to expand that deduction again. In some sense, these are loopholes like anything else. They're arbitrary mechanisms to affect your income and your tax liability in a given year. For better or worse, that is the tax system we have. And it's far better to understand it and where you fit within it. Tax law is written at the macro level to cover millions of Americans. It's broad, it's imperfect, and that also means there's many opportunities to optimize it, to optimize all these arbitrary rules for your specific situation, and that's where tax planning and strategy comes in. We talk a lot about on this channel, when you file a tax return, that's really just a reconciliation of what already happened, right? You're taking your income under the law for that year and deductions and credits that apply, and you're assessing a tax liability. Tax return is retrospective, it's looking backward, and for the most part there's not a whole lot you can do at the time of filing to change the outcome of it. Tax planning is the opposite. It's forward looking. We're still in tax year 2025, and I'm making sure I'm doing the things to reduce my tax liability given my situation. What does tax planning actually look like? Fundamentally, almost every strategy is going to fall into one of these three buckets, or a combination. It'd be timing, deferral, or rate management or arbitrage. Starting with timing, that's the most straightforward because the tax return is just a snapshot. It's one calendar year at a time. And when you're up against a deadline such as 12/31, there's a lot of leeway into what kind of falls within this side of 12/31 and what falls on the other side of it. Businesses can do this all the time. If the year's looking really good, we might start to slow down the timing on our invoicing, especially small businesses where there's discretion on that. On the other hand, we might prepay as many expenses as we can or go all in on some of that equipment we've been thinking about. If we look at it over a 6 or 9 month horizon, we haven't really changed our net income for that time, but we've just changed where it falls on this side of 12/31 or the other side of it, and that pushes the tax liability of what I'm going to be assessed on essentially another 12 months. Individuals have similar options with deferring money in their 401k or making charitable deductions. Most people are cash basis taxpayers, meaning they got to remit the cash to receive the deduction. So it's important to get these things done by 12/31. Second thing to keep in mind is deferral. It's the classic time value of money. Keeping more dollars in my pocket now and having a few and pushing my tax bill off is broadly speaking, generally, a good financial move. That's the basic idea behind all of our retirement apparatus, your 401ks and IRAs and SEP IRAs, all of your pre-tax dollars. You're not paying tax now. You're not avoiding tax. You're just pushing that can down the road many, many years in the case of retirement accounts. Finally, I think where it can get more complicated, but it is tax rate management and arbitrage, because we live in a dynamic system. The system is progressive, meaning as your income goes up, your marginal rate goes up as well. That means that it's not just a time value of money thing when you're pushing dollars off years into the future, like in the case of retirement account. Well, that's kind of a no-brainer. But when you're in a given 2 to 3 year period, you can compare against tax years and what your sense of things is going to be. Businesses get an idea early on of what's a good year, what's a okay year, what's a bad year, and that can be important information as you're deciding whether to accelerate deductions or to pick up income right before 12/31. A deduction when you're in the 12% tax bracket is going to save you 12 cents on the dollar, whereas if you're in the highest tax bracket, the 37%, you're saving 37 cents on the dollar. Throw in a state income tax rate, you can be approaching 50 cents on the dollar. And tax rates can also greatly affect when you recognize income. On something like a conversion from a traditional IRA to a Roth IRA, you need to decide how much to pull out. And a good barometer of that is avoiding jumping into another tax bracket, going from the 12% to 22% bracket or the 24% to 32% bracket. Those are big jumps, and if you have control over the timing of income recognition, that can be some no-brainer tax savings. That is the tax talker for today. You don't have to outsmart the system. You just have to work with it intentionally to save yourself some dollars. We're going to be coming out with so many more videos on tax planning in the next month or two before 12/31. We've already had a few videos, for instance, on the recent tax law change with no tax on tips, no tax on overtime. I have a video explaining how you can estimate your savings from that, and that's certainly a version of tax planning. Be sure to hit that like button, subscribe, and leave me a comment. Ask me your tax questions. I'd love to do a video on a viewer question. We'll catch you next time. Thanks for watching.